What are you making of what the Bank of Japan governor said? Is he in a way almost backing himself into a corner?
Well, it seems like he said a lot without saying much, really, isn't it?
That's usually the case.
Yeah, I mean, it does feel to me like, he hasn't really implied much is going to change. I think most people are still expecting interest rate policy won't shift until March of next year. He has been shown to be very pragmatic, very conservative, so I don't think there's going to be any major shift anytime soon. Having said that, the FX market has been pushing back against JGB moves quite significantly, right? When we initially got that opening of yield curve control up to 1%, we went from 138 to where we were last week, 148.
I mean, are they actually throwing yield curve control under the bus? So will they have to do that in the end because of the yen? And the yen has to be then become the paramount reason that they are doing anything with monetary policy.
Well, it certainly seems like it. I mean, they bought JGBs within the first week of shifting that policy, right? That's obviously had a very negative impact in terms of JPY depreciating. Up here, 148, moving back to where we were last year when we saw a big intervention in terms of JPY buying. I think the market's really pushing up against them, and Ueda's felt the need to step in here. So, whether we'll see a shift in policy, I don't think that's coming anytime soon. But certainly the JPY, I think, now could be an interesting time to take some profits on that US dollar JPY.
So, Tom, you say that the shift in policy isn't coming anytime soon. When is it coming?
Well, the expectation is for it to be in March of next year. A lot of scrutiny on the actual wage data, which you were speaking about earlier, inflation data. Japan has been in deflation for a very, very long time, right? So I think Ueda and the BOJ will continue to be pragmatic on this matter. And whether it's early next year or March or June, we're not really sure yet. But certainly at some point they're going to have to move away from negative interest rate policy.
Tom, we have to talk about the yuan as well, at a record low, despite the fix being at a record high. Where does the yuan go from here, and what does China need to do to keep supporting its currency?
Well, they seem to have taken the policy that they will allow it to depreciate, but along with the Japanese yen, it's depreciated very, very quickly and very, very significantly. So I think where we are at this current level, moving towards that 8 handle is a little bit of a concern for the Chinese economy in general. And we're starting to see these big shifts in China in terms of you're in India, obviously. We're seeing a lot of investors moving into Indian equities. That's been the big trade of the year, moving out of Chinese equities and buying emerging market ex-China. So, these moves are quite significant in the FX market, and we're really advocating for investors to buy U.S. dollar hedge type of exposures to actually get the gains that they're looking for without all of the volatility that we continue to see happening in the FX market.
So, Thomas, you've got, how is it between emerging markets and developed markets now? Where are you seeing the flows? You mentioned where they're going to India, but what about, is there no alternative really but the US?
It seems like, no one's really talking about Europe at the moment. We're seeing a little bit of a disparity between investors. Some are kind of loving the laggards and shifting more towards Europe and UK and even China to some extent, and some are sticking to quality, trimming gains that we've seen this year. It has been quite a good year for a lot of alpha strategies. So there is quite a big disparity happening. The US, there are some concerns in terms of the labor market still. We do think the Fed are probably done here, although there is about a 40% chance for a hike between now and November. But certainly, it could be time to sort of take some profits. And where do you go? There's not really any alternative. Except
you look at the markets, there's not been a broad-based rally. I mean, if you look at the Nasdaq and even the S&P, it's just a few stocks which have driven things, so there must be pockets of huge value within those benchmarks.
Yeah, so that's, we started to see this a lot in June, which was the shift from mega cap, large cap type investments into some of the smaller cap, equal weighted type investments. The problem is with rates so high, it's the smaller companies that really struggle with borrowing costs. We see borrowing costs in the US at levels we haven't seen since GFC. Will those companies be able to maintain their margins and their profit margins? That's yet to be seen, particularly with the labor market so strong. So I think that's why a lot of investors are starting to sort of trim around the edges, move back into shorter duration type of exposures and fixed income, and taking some risk in places like China, not quite yet, but maybe in the next few weeks.